Ladies and gentlemen, Asian guy here. For 10 years, I have woken up at the same time every day. I grab my coffee, I sit in front of my 6 monitors, and I prepare for the violence. I prepare for the 9:00 a.m. smackdown. Every veteran silver stacker knows exactly what I'm talking about. It was clockwork. It was a ritual. The price of silver would be rising nicely in the Asian session, holding steady in London, and then, bam! The New York COMEX opens, and a massive red candle, a waterfall, appears out of nowhere. This wasn't trading. This was an execution. Millions of ounces of paper silver were dumped in a single second, not to get the best price, but to kill the momentum. We called it the tamp. We complained to the CFTC. We screamed into the void. And for 10 years, the tamp happened almost every single day. It was the heartbeat of the manipulation. But something terrifyingly wonderful has happened in the last 30 days. I have been watching the charts, waiting for the smash, waiting for the red candle, waiting for the spoof, and silence. The dog didn't bark. The hammer didn't drop. For the first time in a decade, the smash is gone. This silence is the loudest signal in financial history. It tells us more than any press release, more than any earnings report. It tells us that the algo has been switched off. The specific high-frequency trading algorithm designed to cap the price of silver at key resistance levels has been deactivated. Let's look at the chart. If you pull up the 5-minute chart for silver over the last month, you see something that looks normal. You see a chart that goes up, consolidates, and goes up again. You don't see the elevator shaft pattern anymore. The elevator shaft is when price drops vertically. That pattern only exists when a seller doesn't care about profit. Think about it. If you are a legitimate seller, say a miner trying to hedge or a bank trying to exit a long position, you want to sell high. You want to scale out. You sell a little bit, let the price recover, sell a little bit more. You don't dump 100% of your position in 1 second because that crashes the price and you lose money on your own sale. The waterfall smashes of the past were evidence of a non-economic actor. An actor who was willing to lose money to suppress the price. But now, look at the selling. It is gentle, it is orderly, it is profit-taking. This proves the thesis we discussed in previous videos. The banks have flipped. Why would JP Morgan smash the price if they are now net long? They wouldn't. They have fired the suppressor. The sniper has left the building. We are seeing natural price discovery for the first time in our investing lives. Do you know what natural price discovery looks like? It looks like higher lows. Look at the daily chart. Every time silver dips, it dips to a level higher than the previous dip. $28, $29, $31. This is a staircase. In the manipulation era, we saw lower highs. Every rally was sold, every rally failed. Now, every dip is bought. The psychology of the chart has inverted. This disappearance of the 9 a.m. dump is critical because of market memory. Traders are Pavlovian dogs. They were trained to sell at 9 a.m. because they knew the smash was coming. They front-ran the manipulation. But now, the traders who sell at 9 a.m. are getting run over. They sell, expecting the crash, but the crash doesn't come. The price rallies. They are forced to buy back in higher. This is a behavioral shift. The market is unlearning 40 years of abuse. It is realizing that the abuser is gone. And when a victim realizes the abuser is gone, they start to stand up straight. They start to run. I want you to look at the volume profile of the last 30 days. In the past, the highest volume was always on the red candles. The selling was heavy, the buying was light. Now look at it. The highest volume bars are green, the accumulation candles. This means the big money is buying the rips, not just the dips. They are chasing the price. Institutional capital, the pension funds, the hedge funds, the family offices, they are stepping in. And because the smasher isn't there to slap them down, their buying pressure is actually sticking. We used to say, the price is managed. Now we can say, the price is floating. And a beach ball held underwater when released doesn't just float, it rockets to the surface. We are in the rocket phase. The technical term for this is a change in character, chosh. The character of the silver market has transformed from a mean reversion market, always returning to the low average, to a trend-following market, breaking out to new highs. And notice the news cycle. In the past, good news meant the price went down. Inflation hits 9%. Silver down $1. War in Europe. Now silver down 0.50. That was the manipulation disconnecting price from reality. Now, inflation ticks up. Silver up $0.50. The dollar weakens. Silver up $0.80. The market is responding logically to data. This sounds boring, but in the silver world, logical is a revolution. It means the suppression mechanism is broken. If you are a technical analyst, you know that charts tell a story of war between bulls and bears. For 40 years, the bears had a nuclear weapon, the naked short dump. They could print infinite paper to win any battle. The chart tells us they have run out of ammo, or more accurately, they have decided to stop shooting. The cheating has stopped. And in a fair fight, silver wins. In a fair fight with a supply deficit and massive demand, the price cannot be $30. It cannot be $50. The no smash pattern is the visual confirmation of the banker flip. It is the smoking gun that proves the CFTC report is real. If the banks were still short, they would be defending $32 with their lives. They aren't. They are letting it run. So when you look at the chart today, don't look for resistance. Look for the absence of resistance. Look at the empty space above. That is where we are going. The ceiling has been removed. The sky is the limit. To truly understand why the game has changed, we need to get technical. We need to look at the individual candlesticks. We need to understand the difference between a spoof candle and a real candle. Because the chart is speaking to us, and it is saying that the buyers are now the ones in control. In the old days, let's say 2021, you would often see a specific candle shape on the daily chart. It was a shooting star or a gravestone doji. This is a candle with a long upper wick and a small body at the bottom. What does this represent? It represents a rally that failed. The price tried to go up, hit a wall of sell orders, the spoof, and was pushed back down to close near the lows. This was the signature of the cartel. It was their fingerprint. They would place massive limit sell orders just above the current price. We call this a sell wall. It looked like a fortress on the depth chart. Traders would see this wall and give up. I can't get through that, they would say, so they sold. But often those sell orders were fake. They were spoofs. If the price actually got close to them, the banks would pull them and move them higher. They were phantom orders designed to scare you. Now, look at the charts from the last 3 weeks. The shooting stars are gone. Instead, we are seeing hammer candles. A hammer is the opposite. It has a small body at the top and a long lower wick. What does a hammer represent? It represents a bear trap. The price tried to go down. The sellers tried to push it lower, but suddenly massive buying stepped in. The buyers absorbed all the selling and pushed the price back up to close near the highs. This long lower wick is the tail of the demand dragon. It shows that there are limit buy orders sitting below the market. This is the new reality. JP Morgan isn't building sell walls anymore. They are building buy walls. They are putting a floor under the market. This is known as institutional accumulation. Institutions don't buy like you and me. They don't just click buy at market price. They use iceberg orders. An iceberg order is a huge buy order that is hidden. You only see the tip. You see a bid for 5 contracts. But as soon as someone sells 5 contracts into it, another 5 appear, and another 5, and another 5. The price tries to drop, but it hits this invisible concrete floor. That is the iceberg. We are seeing iceberg buying all over the chart right now. Every time silver drops to $30.50, it stops dead. It doesn't bounce immediately. It just stops falling. That is a whale opening its mouth and swallowing the plankton. We are also seeing the disappearance of laddering. In a manipulation scheme, the banks would use ladder attacks. They would place sell orders at $30, $29.95, $29.90, $29.85. They would execute them rapidly to create a visual cascade of red. Now we are seeing step-ups. The price consolidates at $30 for 2 days. So then it steps up to $31 and consolidates. Then $30. This is healthy. This is organic. This is flagging. A bull flag is a pause that refreshes. In the past, bull flags were smashed into bear flags. Now bull flags resolve to the upside. The RSI, Relative Strength Index, is also telling a new story. In the suppression era, every time the daily RSI hit 70, overbought, the price crashed. It was a reliable sell signal. Oh, RSI is 70, the banks are going to short it. But look at the last month. The RSI hit 70 and stayed there. It hit 75, it hit 80, and the price kept going up. This is an embedded RSI. It happens in strong bull markets. It means the momentum is so strong that overbought doesn't matter anymore. The buyers are voracious. This burns the short sellers. The algos that are programmed to short at RSI 70 are getting destroyed. They short, the price goes up. They short more, the price goes up. Eventually they have to cover, which drives the price up even more. Let's talk about the weekly close. The manipulators love to smash the price on Friday afternoons. Why? Because a weekly close looks bad on the weekend charts. It discourages retail investors from buying on Monday. It was psychological warfare. Don't hold over the weekend, they whispered. But look at the last 4 Fridays. Strong closes. Closing at the highs of the week. This is a massive tell. It means the big money is willing to hold risk over the weekend. They aren't afraid of news. In fact, they are betting on news. They want to be long when the Asian markets open on Sunday night. The chart pattern is no longer a crime scene. It is a launch pad. We are seeing cup and handle formations on the hourly charts, the daily charts, and the weekly charts. It is fractals of bullishness. A cup and handle is a consolidation pattern. The cup is the accumulation phase. The handle is the final shakeout of the weak hands. We just finished the handle. The breakout from the handle is usually explosive. The target is measured by the depth of the cup added to the breakout point. If you look at the 1-month chart, the cup depth suggests a move to $35 quickly. If you look at the 10-year chart, the cup depth suggests a move to $100. The spoofing is over because the regulators are finally watching? No, the regulators are still useless. The spoofing is over because the spoofers have switched sides. Why would you spoof the price down if you own 100 million ounces? You want to spoof it up. And we might start seeing that soon. Reverse spoofing. Massive buy orders appearing to drive the price higher. But right now, they don't even need to cheat to make it go up. The fundamentals are doing the work for them. The candlestick shadows don't lie. The long lower wicks are the footprints of the giant. The giant is buying the dip, and you should be too. When you see a red candle in the morning, don't panic. Wait. Watch the close. I guarantee you by 4 p.m. that red candle will turn into a hammer. That is the hammer of God smashing the shorts. The market structure has healed. It is no longer a casino rigged against you. It is a free market. Finally. And in a free market, silver is not $30. We have looked at the microstructure, candlesticks and spoofs. Now we need to look at the trend. The trend is your friend until it bends. But for silver investors, the trend has been an enemy for a decade. It was a downtrend. It was a sideways grind. But recently, a technical event occurred on the chart that signals a epochal shift. It is called the golden cross. This is when the 50-day moving average, the short-term trend, crosses above the 200-day moving average, the long-term trend. In the world of algorithmic trading, the golden cross is a buy signal of the highest order. It tells the trend-following funds that the bear market is officially dead. It tells the pension funds that it is safe to enter the water. We just saw a golden cross on the daily silver chart, but this one is different. Often you get a fake cross where it crosses and then dips back down. This time, the angle of separation is steep. The 50-day is shooting up like a rocket. The 200-day is curling up. This is a high-energy cross. And look at how the price is respecting these lines. In the manipulation era, the moving averages acted as resistance. The price would hit the 200-day MA and crash. It was an electric fence. Now, the moving averages are support. They are a trampoline. Every time the price corrects, it touches the 50-day MA and bounces hard. This confirms that the sentiment has flipped from sell rallies to buy dips. The banks use these averages to manage their risk. When they were short, they defended the 200-day MA. They would pile on shorts right at that line to ensure the golden cross failed. The fact that the golden cross succeeded and is widening proves that the banks have stepped aside. They let the cross happen. They wanted the cross to happen. Why? Because it brings in new buyers. It brings in the momentum funds. Let's talk about on-balance volume, OBV. This is a technical indicator that measures buying pressure versus selling pressure. It adds volume on up days and subtracts volume on down days. Historically, silver's OBV was flat or declining. But look at it now. The OBV is making new all-time highs before the price makes new all-time highs. This is a leading indicator. It means that huge volume is entering the market on the up days, and very little volume is leaving on the down days. This is the smart money accumulating. They are buying quietly, absorbing supply without spiking the price too much yet. But the OBV gives them away. It shows that the float is being sucked up. The Bollinger Bands are also screaming. Bollinger Bands measure volatility. When they squeeze tight, it means a big move is coming. We had a squeeze last month. Now the bands are expanding. The mouth of the alligator is opening. The price is riding the upper band. This is a sign of extreme strength. It is walking the band. In a manipulated market, the price would hit the upper band and be slapped back to the middle. In a free breakout market, the price pushes the band higher and higher. It refuses to revert to the mean. The chart is also showing a series of higher highs and higher lows on the weekly time frame. This is the definition of a bull market. We have broken the multi-year downtrend line that started in 2011. Draw a line from the $50 peak in 2011 to the $30 peak in 2021. We have broken above that line. We have backtested it, touched it from above to confirm it is solid. And now we are launching from it. The backtest is crucial. It was the last chance for the bears to regain control. They failed. The support held. The resistance has become support. The ceiling has become the floor. This is why technical analysis works. Not because lines on a chart have magic powers, but because they represent the collective psychology of the market participants. And the psychology has shifted from fear of the banks to fear of missing out. The pattern also shows a lack of overhead supply. When you look at a volume by price chart, there's a lot of trading history between $20 and $28. Lots of people bought and sold there. That creates friction. But look above $30. Look above $35. There is very little volume history. It is an air pocket. When the price enters an air pocket, it moves fast. There are no bag holders from 5 years ago waiting to sell at $40 because silver hasn't been $40 in a decade. The only resistance is psychological, and psychological resistance breaks easily when FOMO kicks in. The moving average convergence divergence, MACD, on the monthly chart has just turned green. The last time the monthly MACD turned green from this level was 2010, right before silver went from $18 to $50. It is the exact same setup, the exact same geometry. The chart is a map, and the map says we have left the territory of suppression and entered the territory of discovery. The cheating required to stop this momentum would need to be 10x larger than anything we saw in the past. And the banks don't have the stomach or the balance sheet for that anymore. They stopped cheating because the cheat stopped working. The golden cross is the final nail in the coffin of the bear market. We have analyzed the daily candles, the weekly trends, and the moving averages. But now we must step back, way back. We need to look at the God chart, the chart that covers 45 years of history, the chart that reveals the true magnitude of what is happening. We are looking at a cup and handle pattern that spans 4 decades. The cup started in 1980 at $50. It bottomed in the 90s and 2000s. It came back up to the rim in 2011 at $50. Then, from 2011 to 2024, it formed the handle. This is not just a chart pattern, it is a geological structure. A 40-year base is unheard of in financial markets. The bigger the base, the higher in space. The energy stored in a 40-year consolidation is nuclear. When an asset breaks out of a 40-year pattern, it doesn't just go up 20%, it goes up 500%, it goes up 1,000%. It enters a super cycle. The handle of this pattern, the last 13 years of pain, was the manipulation. That was the bank suppressing the price to build the handle. They kept it contained. They shook out the weak hands. They transferred the silver from the impatient to the patient. But now the handle is complete. We are breaking out of the handle. The neckline is around $30, $32. We are piercing it. We are closing above it. Technically, the target of a cup and handle is calculated by measuring the depth of the cup, $50 down to $4, so roughly $46, and adding it to the breakout point, $30 or $50. That gives a conservative target of roughly $80 to $100. But that is just the measured move. In a commodity shortage, coupled with a currency collapse, the technical targets are often blown away. This chart proves the manipulation is over because you cannot suppress a 40-year breakout. It is like trying to stop a volcano with a cork. The pressure is too great. The banks know technical analysis better than anyone. They see this pattern. They know that once $50 is breached, the algo buying will be global and instantaneous. The $50 level is the Maginot Line. It is the line the banks defended for generations. But they have abandoned the fort. They are no longer massing troops at $50. They are buying call options above $50. The chart of truth shows us that silver is the most undervalued asset on the planet relative to its own history. Stocks are at all-time highs. Real estate is at all-time highs. Gold is at all-time highs. Silver is 50% below its 1980 high. This anomaly cannot persist in a free market. It only persisted because of the cheating, the spoofing, the naked shorting. Now that the cheating has stopped, silver must catch up to the other asset classes. It is a coiled spring that has been compressed for 45 years. Imagine the violence of that release. It will not be a gentle rise. It will be a repricing event. The chart suggests a vertical phase, a phase where the weekly candles are $5, $10 ranges. This is the slingshot. The deeper the pullback, the harder the shot. The manipulation pulled the rubber band back until it almost snapped. Now they have let go. The psychology of this chart is shifting from despair to hope to euphoria. We are currently leaving the hope phase and entering the belief phase. The euphoria comes at $100. Charts are simply visual representations of truth. And the truth is, the sellers are exhausted, the buyers are energized, the manipulators have defected. So when you look at the chart, don't just see lines. See the surrender of the enemy, see the white flag. The absence of the smash is the white flag. The higher lows are the white flag. They stopped cheating, not because they became moral, but because they lost control. The physical market overwhelmed the paper market. The chart is finally reflecting the reality of the vault. And the reality is that silver is going to the moon. The pattern is confirmed. The breakout is here. The only thing left to do is hold. Do not blink. Do not let them shake you out on the launch pad. The chart says we are clear for takeoff.